This video is going to be all about global index funds. I'm going to go through what they are, why I use them, the specific global index fund that I use, and then look at some of the pros and cons of using global index funds. So first of all, what are global index funds? Well, I made a whole separate video on index funds, so check that out if you want to know more information. But an index fund is just a basket of companies. So rather than owning one, you can track an index such as the FTSE 100 or the S&P 500. You can then take this one step further and track the All Cap index or the All World index. Both of these indexes are global indexes. The benefits of index funds are that they're low fee, they're passive, they're hands off, and you track the market rather than beating the market. I won't get into it now, I've gone over it in a separate video, but it's impossible to beat the market more or less over the long term. So a global index fund is an index fund that tracks the entire global economy. You're globally diversified across different companies, different countries, different sectors and industries all over the world. The best thing about it is that they are market weighted in each country in proportion that that country makes up the total global stock market. So in layman's terms, what that means is, for example, the UK makes up 5% of the global stock market. So in a global index fund or ETF, UK stocks should account for about 5% of the holdings. The US makes up about 55% of the global stock market. So in a global index fund or ETF, US stocks should also make up about 55% of the holdings. And then what will happen is, as economies around the world grow and shrink over time, this will then be reflected in the global index fund. So the UK in a few years' time makes up 7% of the global economy. The global index fund will then account for that, and the UK stocks will then make up 7% of the global index fund. So what I'm trying to say is you're invested in direct proportion into each country, not just country, but also industry, sector, and company that makes up the proportion of the total stock market.
Hey, that's pretty good.
The reason why I use them is because they fit my investment style and strategy, which is very hands-off and boring, but not just that, it's simple and automated. So before I get into explaining simple and automated a bit more, my approach is mainly to use index funds and specifically invest monthly into global index funds. Of my total stock market investments and portfolio, global index funds make up roughly 75%. So going back to the two reasons why I use them, that's simple. I don't need to own, and neither do you, 3, 4, 5, 6, 10 different funds. You just need one global index fund, and that is the only stock market exposure you actually need.
Easy peasy lemon squeezy.
If you want some bond exposure, you can then get a global bond index fund, and that's the only two funds you possibly need. Right now, I don't invest into bonds, I'm purely stocks. So a global index fund really is the only fund that I need. It's very simple in the sense that I've just set up automatic monthly payments, and I've done this for a number of years, and that's all I need to do. I don't need to spend my time researching companies, looking into different things, rebalancing my portfolio. Don't need to do any of that. Just have a monthly investment into a global index fund. And then linking into that, the second point is automation. I don't need to do anything manually. I have automatic investments set up into both my stocks and shares ISA and my lifetime ISA into a global index fund, and it's completely automated and hands-off. So the global index fund that I specifically use and invest into inside of my stocks and shares ISA and my lifetime ISA is the FTSE Global All Cap. It tracks the All Cap index, it's got nearly 7,000 stocks, it is globally diversified, and it's got a 0.23% expense ratio. So for a globally diversified index fund where you're investing in nearly 7,000 companies, it's very, very low fee. And when I mentioned 75% of my total investments are in global index funds, about 72% of that money is in the FTSE Global All Cap. The other 3% is split between two global ETFs. One is on free trade, which is the VWRP, and one is on trading 2-on-2, which is the VWRL. Both of these are FTSE All World trackers, and they are ETFs rather than index funds. Across them two platforms, I've now got a little bit of money into both the VWRL, VWRP. The only difference is the VWRL is income, whereas the VWRP is accumulation. Income, you get dividends as cash. Accumulation, it reinvests the dividends, but they're both still global ETFs.
Relax and take notes.
So comparing the FTSE All World ETFs, the VWRL and VWRP, to the FTSE Global All Cap, there is a difference in the sense that the FTSE All World ETFs only have about 3,500 stocks, whereas as I mentioned, the FTSE Global All Cap has nearly 7,000. The reason why is because the FTSE Global All Cap invests into both large, medium and small size companies, whereas with the FTSE All World ETFs I mentioned, they only invest into large and mid-sized companies, which is why the FTSE All Cap has so many more stocks. However, and it's been shown over the last few years, they generally have very similar returns just because these small cap stocks that are included in the FTSE Global All Cap only make up a small percentage of that index fund, and also the largest companies in the world, Apple, Facebook, Amazon, Microsoft, are the largest components in both the FTSE All World and FTSE All Cap, and that determines a lot of the growth in them index funds and ETFs. But as I mentioned, most of my money is in the FTSE Global All Cap, and I harp on a lot about index funds, and not just index funds, but specifically the FTSE Global All Cap index fund, and that's what I invest into through my stocks and shares ISA and my lifetime ISA. So that is what are index funds, why I use them, and the specific ones that I use. I now just wanted to talk for a few minutes about a few pros and cons, because like anything, there are some pros, there are some cons of actually using global index funds, and hopefully this can help you work out if it's the right thing for you to do as well. So finally, moving on to some of the pros and cons of index funds. So firstly, the pros. A lot of the pros are things I've already mentioned. First of all, they're globally diversified, which is the most diversification you can get in the stock market. Second of all, they're very simple in the sense that you only need to invest into one fund. You don't need multiple funds. There is quite a popular strategy called the free fund portfolio, where you'd have a US stock fund, an international stock fund, and then maybe a bond stock fund or a separate emerging market stock fund. But you don't need that with this, I guess, strategy and approach. You just need one global index fund, and that's job done.
Easy peasy lemon squeezy.
So because you've only got one fund and not 3 or 4, the main pro is investment return. So over the last 100 years, the US stock market has returned more than the global stock market. So I guess going back to what actually makes up a global index fund, it's about 55% US stocks. So even when the global stock market, even when the US stock market, does well, the global index fund is still going to do well because more than 50% is US stocks. However, you can't deny that the US stock market has performed better over the long term compared to the global stock market. However, a thing I would say about this is, and this is probably a disclaimer you get before you make any investment, past performance does not equate to future gains. It's impossible to know what is in the future and what is going to provide the best return in the future, what country, what company, what sector or industry, which is why with a global index fund, you are covered no matter what happens. As companies fail inevitably and grow, the global index fund is going to include them companies in it, and it's going to slowly build your wealth over time. But that doesn't take away from the con that if you had just invested solely into the S&P 500, you would have a higher return compared to investing in a global index fund over the last 50 years. But I guess, yeah, it's a good point to re-emphasize the point that if you do only invest into the S&P 500, then should the US economy perform badly in a decade or over the next 50 years, which you wouldn't expect it to, but it's also impossible to predict ahead of time, even though it may be obvious looking back. It's impossible to predict what is going to be the best performing economy over the next 50 years when I'm investing. So I just know with a global index fund, whatever economy, whatever country, whatever industry does well, I'm going to be participating in it. It's going to be building my wealth slowly over the long term. It's simple, it's automated, and that's what I want out of my investments.
Boom.
One approach you could take is have a global index fund or ETF as the backbone of your portfolio, and then maybe have a couple of extra funds in there if you believe in a certain country like the US, or a certain collection of countries like emerging markets, or if you believe in a specific industry like tech. But personally, my approach, 75% of my portfolio is in global index funds and ETF, invest into them monthly through tax efficient wrappers like my stocks and shares ISA and lifetime ISA, and it's all about them just buying and holding for the long term. And that wraps up this video on global index funds. Thank you for watching. Hopefully I've managed to convey the point well as to why I use them. Essentially, global diversification, it's simple, and I'm going to choose which country is going to perform the best, because I'm going to invest into all of them through the global index fund. But if you do invest into any, let me know which ones in the comments. And if you don't invest into any, I'd be interested to know why, just because obviously I'm always learning and looking to see, I guess, opposing arguments to what I do personally. So particularly if you don't invest into them or don't believe in them, please let me know why. But yeah, that wraps up this video. Thank you very much for watching.